Good afternoon, everybody. I am an associated member of T3 Trading Group, which is an SEC registered broker dealer, a member of FINRA SIPC. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. There's the position disclosure. New position on Apache today. I almost didn't keep it, but I kept it. Kept a little bit. Had pretty good pricing on it. Let's hop into the charts. Man, wow, what another bearish day. We basically close on lows again, or what? SPYs are down. SPY's down about 0.7%. IWM's down. Sorry, the Qs are down 0.4%. IWM's down 0.65%. So a little bit of relative strength from the Nasdaq. This market looks atrocious. Absolutely atrocious. Absolutely atrocious. We haven't even gotten a single real price correction in this entire 4-day down move here. We're down 4 days in a row. Hasn't even been a single price correction to get excited about trying to short on a big picture. But by the time we get a price correction to think about shorts, we'll probably be bouncing off 390 and have fulfilled the technical head and shoulder pullback here. And then the question will be, well, did we miss that trade entirely on the short side? It was there, but they certainly didn't make it easy. Even going back to Friday last week, the Jackson Hole day, I just thought that was a very difficult day to actually get short with the way that we, printed new highs, right as Powell was speaking, only for the aftermath here to be $25 worth of downside. So market looks terrible, but we just are continuously 1 degree or another of extended. Once again, as of the close today, we are extended by $10, and I feel like that's just been very consistent. Almost every afternoon meeting we're doing, I'm looking at a market here that's extended the downside from the ADMA by $10, and sometimes it rests intraday and then kind of gives downside continuation. That's pretty much what we saw happen again today. In some ways, it's like the opposite, and I know we were talking about this on the way down, but it's the opposite of these several 3-day up moves that we had spent so much time analyzing on the way up. Where after the first day, you'd be a little bit extended, the short-term tactical sentiment would be, in that red zone, and then for day 2 and day 3, you would rest in the morning and get continuation. You'd rest in the morning and get continuation. It's kind of been similar to that, except now we'll gap down, we'll fill the gap, whatever, or in this case, we gapped up this morning and filled the gap back down, go sideways a lot, and then eventually, kind of close weak. But this market's been atrocious. It seems like, I know Pat kind of has mentioned this also, and it seemed like it again today, but there is not a single person buying anywhere that you can look in this market. I think we saw like 10 minutes of index buying today before that kind of fell apart when we got back above $400 there early on in the day. There have been some pockets of relative strength. I still think it's interesting and notable that I'm almost taking back what I'm saying as I'm saying it. I think it's interesting and notable the last couple of days that growth has not been as bad as I feel like it should have been. Air quotes should have been, which is always notable. The flip side is that growth went first. It was weakest earliest, kind of from the top. You can see that obviously, looking at a daily chart of like a Carvana, right? Like before the market even came down, this thing had already retraced from almost $60 down to $35 as the market itself was even, kind of peaking and coming down a little bit. But last few days here, including today, like it seems like we're getting a really strong growth trade off the open, and then the market just doesn't let it go. This market has just been so heavy. Going back to the SPYs, just looking atrocious. 390 is that next level. And like I'm saying, there's not a buyer in sight, but I guess the real question is, was there a buyer even in this up move? This up move here was primarily short covering, short squeeze, hedges being unwound, and not real new long buying coming in so much. So if they're not doing that anymore and those longs still aren't coming into the market, well, maybe this is the price action that you actually get as a result of it. On the small time frame, just garbage price action. We had a pocket of strength off the open that led to, once again, some really good opening drive trades. Technical common gap to the upside. We opened up right at $400. The high, we took 399.99, pretty much right at the open, filled the gap, created an interesting looking pivot, worked our way back up. I remember watching this candle forming as it was working its way towards $400 and thinking, wow, this actually looks really productive. And once again, the names that we were looking at based on the morning meeting, which was kind of primarily growth and energy, were both trading really well. I'm like, oh man, this market's on my side. Like that Shopify was trading great. Pins and Snap obviously were trading great, but they were in a little bit of a world on their own, just because of the news that came out in the Snap pre-market. But the Shopify was trading great. I know Path was being chattered about a little bit in the VTF. That was trading pretty decently. So a lot of growth was looking really good here. A lot of things that we were buying. PayPal, that was another one, looking fantastic. Market gets above $400. It's kind of like our initial all clear. And what I was saying here is like, all right, we're above $400. It looks great. Apple above 160 was really important, kind of happening at the same time. I need the market to hold above. And the thing that was going to give me more confidence would be if the market was holding above 400 and the ADMA on the five minute got to 400. And that never happened. We spent, 12 minutes or so, 15 minutes maybe total above 400 in the SPYs. Very quickly we pulled down. The ADMA hadn't caught up to 400. This wasn't necessarily the end of the world. This pulled back to the ADMA on the 5 minute of the SPYs, even though we got back below 400. But like I kept saying at the time, I was like, we need to pivot quickly. We need to pivot quickly. Like ideally we just overshoot back down 400, touch this ADMA, pivot, back up, higher low, back above $400. It shook some people out. Continuation coming in on the upside. Didn't happen. This bar closes at lows. Next bar comes in. I remember even at watching this candle super closely at 10 a.m. how it was forming. Because at one point, it kind of touched the 21 here and was looking like it wanted to pivot back up. And I was thinking to myself, like, all right, let me see how this candle closes. The pullback here is deeper than I want it to be, but it's not necessarily the end of the world. Same thing, though. I need to pivot basically now. Like if this candle here closes a continuation hammer and the candle closed at, 399.50, 399.60, and now we're pivoting, and next thing I know, pretty quickly we're getting back above $400. I can still live with that. But it was once this candle closed on lows and the following candle broke that low that it was a wrap. It was a wrap. My entire probably tone chatting to the virtual trading floor changed pretty much in that moment because the market just wasn't giving the confirmation that we need for higher on some of the really good looking positions that we were focused on off the open, which it sucks, but it is what it is. We're in a really weak market here. I have continuously over the course of the last couple of days looked for the market to give some degree of a rebound, some degree of price correction, and it just has not happened at all. Even for the 10 minutes today, 15 minutes today, when the market was actually looking good, and another 10 minutes later, I was telling you it was done. So, I was definitely feeling pretty excited here as we're breaking above 400, as we're trying to hold above 400, this inside day, this potential pivot, pull back to the ADMA, fine. But once we got to 10:05, there was nothing to do. And it's unfortunate. Hopefully you have your positions on already. They're in the money. You're managing them properly. You're getting your risk covered. You have your game plan. You're trailing them. You're locking in money on some of those positions no matter what. But I really think that once this candle closed at 10:05, it just told us that there's nothing to do here. I still, even at that point, was thinking to myself that it'd be very difficult just because of the degree of big picture downside extension to get real big downside continuation today. So it was almost like one of the worst things that could happen happened. It just went sideways. So just bearish consolidation for pretty much the entire day with a downside grind to it with a really weak close. It is the last day of the month, so it will be curious to see if, as we start September, if there's any change to this, because we know that the data that came from Goldman was that there was a pretty decent sized selling that needed to happen in the equity market for just kind of end of month rebalances from the big funds that are out there. I think we saw just a couple days ago that there was still like $27 billion worth of selling that needs to happen. So, if you combine people not being in a rush to buy this market, post the Powell comments with $27 billion of rebalance on that needs to come in, In a market environment that has negative gamma, we're selling leads to more selling. In a market environment that has lower general liquidity, um, it's not that surprising to see just how weak that we've been, and again, it does kind of beg the question a little bit if we get into September 1st tomorrow, if that'll abate a little bit. But I don't think it's something you can count on. I think it's just an extra detail, an extra piece of information that we can keep in the back of our mind, because there just has not been any buying here. There has not been any buying in this market since Friday last week, 10 minutes after Powell started to speak. Like, you can't even point to, you can barely point to a spot on the chart and say that there's any more than just even this downside extension that got blown up a little bit. That's more like shorts booking profit and buying, I feel like, than actual longs coming into the market. And again, this 15-minute period here this morning where we had this doji come in to the moving average and we're working our way back up, it seemed like that was the only pocket of buying we've seen in this market at all. It's been incredibly weak. So is what it is, and it's been very difficult to execute these mornings because it's we keep gapping into areas where you're not extended enough to feel confident really on the buying. Maybe on this morning here, the second day, we were so extended with that gap down to $400. There were some okay kind of opening trades there, and then even that day we ended up being super weak. But we're never really opening up down enough to be able to come in and buy. We're not gapping up enough to give you the short setup to actually short because we're still extended to the downside. So it's just been a few tricky days here. I know a bunch of us would have loved this morning if we had a big gap down. At this point, still applies for tomorrow, though. I don't necessarily expect it to happen, even with the weak close. I just don't think that the market wants to give us that layup right now. If we again, we closed here at 395.50, let's say. ADMA is at 406.50. Extending the downside by $10-11 from the ADMA on the daily chart. If you had a gap down to in front of 390 tomorrow, I don't see how you don't buy that degree of extension. It's such a huge level. That would be a layup. But the market just has not been giving us that layup. It's been consistent, difficult opens. So I think, as a team today, though, we did a really good job in the morning meeting figuring out what to focus on and then navigating the market intraday with what it actually gave us. Taking advantage of the strength when it was there, and then unfortunately pretty quickly by 10:05 saying, hey, there's nothing to do. And then that was the key for the entire midday of the trading session, is not doing anything, having no advantage. You look at this price action between once we failed at 10:05 and honestly all the way through the close. There's just nothing really to bite onto here at all. But again, the focus on names was certainly on point. Spent a lot of time talking about energy stocks this morning. I really liked this gap down to 79. 80 was a key area. You need to see XLE get back through 80. I was buying the gap down. I got back involved in Apache. Apache paid me pretty well. I was buying $38 and even below $38 pre-market and intraday, so that worked out really well. I was rebought CDEV at $8 off the open. It gave this a big move, and this did not close well, but this gave a great move. I think I bought literally $8.02 pre-market. Gave a move all the way up to $8.70. That worked out really well. I added to this HLX at lows, but these are not great looking tails here at the end of the day. I don't love how this XLE candle closed. I don't love how that CDEV candle closed, how that HLX candle closed. Even this Apache didn't close great, not terrible either. So I almost liquidated the position into the close again, but it just decided I want a little bit more oil exposure, so I'm going to keep it for the moment. But I lightened up. I do not have a lot of Apache. Paid me well intraday though. So we were looking at XLE for the dip buy in the same breath as we were looking at, I think, growth stocks to be able to. It's like I said in the morning meeting. I feel like the last couple of trading sessions in a row, each morning these growth themes are trying to be really strong, and then the market's kind of causing them to fail. So today I was like, all right, well, maybe today's going to be a little bit different, where the market doesn't cause us to fail. And if these are trading great early and the market's actually trading well, they could be huge moves. And I remember looking at Shopify, which is one of the ones I was in, and look at this move up the open, phenomenal. I remember looking at this thing racing higher, and even as it started to pull back, which is natural and expected given this degree of a move to the upside. I don't remember what percentage it was up at that point, and it still closed positive on the day. It still closed up a percent. It just shows you how relatively strong these growth things are, and that's with this couple dollar pullback off of highs. I just remember looking at Shopify and looking at the market as the market was potentially beginning to pull back, and being like, man, if I could just get a real price correction, this buys back to 407. I feel like I'm looking at a Shopify that's having like a 10 to 15% update today, and it could be a massive upside day for this type of stock if the market can just cooperate a little bit. Correct this upside extension from this massive opening move from time or price. It even tried to, right? Had this big pulled back into the ADMA, and tried to bounce real hard off that. But what time of the day is this? 10 o'clock, 10:05. This is exactly when the market was failing. And I was like, man, if this market could just give me that pivot, SPYs get right back above $400, hold the ADMA, the relative strength on this thing, I could be looking at a massive move for Shopify, for some of these other growth stocks that we're looking at as a team that were acting so strong early on in the day. And then, just once again for, I don't know, third day in a row? Yeah, third day in a row. Two trading sessions ago, gap down, and this is, I'm just got Shopify up, but this is the same thing for almost every growth stock. Two trading sessions ago, gap down, first thing to go green, looks like it wants to get great upside follow through, market fails. Yesterday, the market had that little gap up, right off the opening momentum. Market causes it to fail. Today, gapping up along with the market. Market pulls back in the first 5 minutes, right? With the first 5 minutes of the SPYs today. Just 5 minute, negative candle here, pulling back off $500. Off of that was the SPYs pulling back off $400. Shopify first bar, nicely green. And again, same thing. You could be looking at almost any growth stock that was on our radar today. Fantastic follow through. Market just eventually just weighs on this thing in such a way that it causes it to fail. So, we're certainly looking at the right spots. There's certain things you can control, there's certain things you can't control. The main thing that you can do is control your actions in respect to the market. You can't, control what the market's going to do. But we do have to pay attention to the market as a very important layer of probability. And we recognize that the market as a layer of probability is really not on your side right now for the longs, with the exception of extension, right? Like what I always say about how markets work is you're generally off trading in the direction in which the market moves. It's just easier money. So in this market where we are right now, it's pretty obvious here in an afternoon meeting that you're better off, shorting the last 4 days than being long, right? But you have to do that in conjunction with your extension rules, because your extension rules are what's breeding like a lot of the risk reward and honestly a degree of the probability. So I'm going to have a worse risk reward and a lower probability of success shorting, even though shorting is the right thing to do based on the market with these larger degrees of downside extension. The problem is we're not getting, it's like I was just talking about earlier in the meeting, we're not really getting any relief on the extension to the point where you can have a better setup for the short side that gives that better risk reward. And we're not getting any upside price correction to make money on, smaller time frame upside retracement longs. So, just a really tricky couple of days here as far as how we've set up every morning. But I don't think that we couldn't have navigated it better, I don't think. Focusing on energy and focusing on growth, it was the right things to be trading off the open today. And then recognizing at 10:05 today, like, hey, this market just told me that it's going to fail on the long side, so I can't go after that. I don't want to press things to the long side right now because we just failed. Yeah, I'm back into the same extension problem. It's like the market feels like it really wants to be going. I mean, when you get this failed break up above 400, that should really be a signal, especially in a bearish market, that we're going a lot lower. But it's so hard to go a lot lower when you're trading at, again, 399 with your ADMA at 407. Um, it's just a lot of extension to the downside for this market to be able to push further down. And it's not to say that it can't. It can. It absolutely can push further down, and that's what happened yesterday. I still will stand by the fact that I think that the degree to which we pulled below $400 yesterday is a lower probability move given the degree of extension. So that's still what I'm talking about. It's not that we can't go down. It's just that it's more difficult to go down when you're dealing with this degree of extension, and it makes your risk reward and probability of success worse. But it's easier for markets to be extended and continue down than it is for markets to be extended and continue up. And that's just because fear in the marketplace is such a stronger emotion than greed. People tend to be much quicker to pull the trigger on just liquidations or being forced to liquidate through margin calls or whatever it is than they are just to continuously chase upside price when they kind of feel like they missed it. Except for those rarer market environments where they're kind of going into a bubble and the next iteration of Wall Street bets is coming around. So I think that's today's recap. So again, focus on the right stuff. Just hasn't been making it easy. I am happy to say, how's PSTG doing on their earnings per story? This company's a monster. I like this company. Up 5% after hours on their numbers. $31. It's a big level. Tencent aims to divest $14.5 billion stock portfolio this year. Interesting. I know DKS is not a stock that we tend to look at in this room, but I really like the way it moves. Okay, awesome. Then do what works for you. Tends to be, I find, a little bit of a slower mover, but it's a little bit more expensive. So if there's opportunity for you and you're trading it well, you have a good feel for it, by all means, do it. Go for it. Daily chart looks a little bit sloppy to me here. From Daniel. Just an overall idea, in which case do you think markets will react all-time highs with rates going into fours? Just an overall idea, in which case do you think markets will reach all-time highs with the rates going to fours? So I've been kind of saying this for a long time now, and this was a hell of a rally though. I have kind of been of the thought process, and to me it seems like this is what the Fed wants to manufacture, that we could just be in a bigger, wider ranging market for a longer period of time. I think it's going to be a huge struggle for the market to see all-time highs with interest rates continuing to move up and inflation being where it is. The Fed doesn't want that to happen, and don't fight the Fed. I think that was like the conclusion of one of Pat's notes at the top. It was like, the Fed doesn't want this market up here, don't fight the Fed. And then we've kind of seen what is happening there. Should we be looking at the markets as bears, meaning with those big updates there correcting back down? Yeah, so I guess just kind of sticking with the overall thought process. If you ask me in this moment here, what do I think is more likely, all-time highs or New Year lows? I probably would say year lows. I definitely would say year lows. But I still think that the market wants to keep a bid, if the Fed wants to keep a bid under this market and try to keep it. We're going to start seeing, as this market deteriorate, it's the same thing we've seen all year. As this market continues to deteriorate, you're going to start seeing the Fed start making more dovish comments again. Because they're trying to engineer this soft landing. They can't have the market do what it just did and be up at this peak. That's why Powell just did what he did. But at the same time, they don't want SPY 260. They probably would rather SPY 260 with 2% inflation than SPY holding up a little bit better, but super high inflation. But they're trying to engineer the soft landing. So every time we start seeing this market act a lot weaker and work its way back down, you start seeing the Fed change their tone. It's been this way the entire year. So I wouldn't be surprised. You get a few more days of this price action, and all of a sudden these Fed members who are talking, like Rock said this morning, like, these guys just need to stop talking. Like, these guys are just talking too much. And I get it. They're trying to use their power of language to basically manipulate the market. But at a certain point, it's like, guys, just shut up already. Just talk a little bit less. um, but that's going to be the next comments that come out on the Fed. It's like, oh yeah, inflation is improving. The jobs data, this, that, the other, and next thing you know, the market's going to be talking about a dovish pivot again, and we'll see. And Josh, the flip side of that though is the market will hit all-time highs eventually. Of course it will. It just depends on, unless there's a real end-of-the-world catastrophe. It just depends on your timeline. As traders, we shouldn't really be thinking about highs. But as investors, there's no reason why it shouldn't hit all-time highs at some point. Yeah, for sure. I mean, we're traders. From an investing perspective, I always just tell people, just dollar cost average in the companies you believe in. It's a totally different thing. From a trading perspective, we might see sideways-ish price action with low liquidity and a lot of volatility for another year and a half. It could easily happen as we work our way through, just the environment that we've been in. That kind of seems to be our new normal. So, yeah. But this move here over the course of the last 4 days is sick. But this entire year, you guys, does anyone remember 2019? I think it was 2019, right? Where the biggest pullback the entire year, not intraday, from highs to lows, the entire year was like 2%, and it was like the first year ever that the market didn't have a pullback more than 2%, and now it's like every day the market's pulling back 2% or the opposite. Like these, some of the downdrafts we've seen this year are just so sick. These 4 days here, this price action was just totally insane in mid-June. The January pullback, the February pullback, just crazy. Also, to follow up on Daniel's question, you got to know the market you are in. You can't be buying things up in this market. This is the type of market you got to buy dips and sell rips. Yeah, for sure. So you got knowing the market environment that you're in is key to long-term success in the trading business. Period. Because market environments change, and you have to change with them. And this has been a market environment where I really think that this price action, even though we're in a bear market, and I don't know what percentage we're down from highs and the SPYs right now year to date. If I had to guess, I would guess 15%. Qs are probably still 20+% at this point. Even though we're in a bear market, it's been a two-way market this year. There's been a lot of opportunity to make money on both sides. I've certainly done better the long side of the market. It just tends to be I'm a better trader to the long side than I am to the short side. I'm not afraid to short. I'm much more cautious to be able to do it. But it's certainly been a two-way market. Some of the up moves this year have been face ripping, and we know the data shows the biggest up moves in the history of the market usually occur within bear markets. And that's just because volatility increases so much. Like I said, you could make your entire year just off of properly timing the March rally and the July-August rally and be a long-only trader. And obviously that's just two small periods of an entire calendar year, let alone all the other opportunities, the shorting opportunities, the momentum opportunities, the smaller short squeezes that we had in this market, smaller rallies that we had in this market. And this year has really been all about market dynamic data and relative strength and relative weakness. Relative strength and relative weakness, I feel like, has never been more important than it's been this year, at least from my recollection from my trading career. And the market data has been so key. The way that we were able to call some of these bottoms, and we have called every bottom. We called this bottom. We called this bottom. We called and crushed this bottom. I think this little rally here we had called really well, and then obviously this recent rally off of lows. A lot of that just comes from, and honestly, even calling this top up here, we didn't call it a top at the time in the same way that we didn't call any of these bottoms at the time, because that's just not what a prudent trader does. They don't look at this point in real time and say, hey, this is the top, or look at this point in real time and say, hey, this is a bottom. What we do is we look for areas that are strategic where the market should retrace in the opposite direction after giving a big move, right? And that's exactly what we've done here with consistency. And then we have rules in place on how we can capitalize for when those retracements actually become bigger moves, right? That's what we are, seeking to do with consistency. And so much of understanding these big picture pivot points that have occurred throughout the year 2022 and nailing what in hindsight became top and bottoms has been in the market dynamic data that comes primarily from Pat's morning note. Bill is awesome to provide some of that information to us as well. Just really recognizing when sentiment hit certain points and positioning hit certain points, that this market's ready to go in the other direction. And honestly, with the highs too, this high here at the end of March, this high here in August, it just reached the point where a combination of technicals, especially technicals on this one is so clean, and those market dynamics are telling us that the short squeeze can basically stop. That's why I have been saying here, let's see a 3 to 5% pullback if loans really come into the market or not. And the obvious answer is that they haven't. They haven't, and that's why we didn't just pull back to 410 and then rally all the way back up, because the loans never came in. Powell didn't make them come in, and we just had further deterioration. But it's a combination of technicals and measuring and understanding extension rules in combination with that market dynamic data has just really been the key to nailing the big pivots of the entire year for 2022, and that is what has led to the biggest profitability. And if you look at it in that regard, a lot of times, and this is what we're experiencing again right now, a lot of times the in-between price action has been very difficult. Like right now, I would describe us as being, the last few days is in-between price action, right? We're not we're not seeing any signal here for a major pivot low to kind of come back into this market, or a major signal for a major pivot high to come into this market at this point. It's just kind of just the in-between price action, and that's where it's tended to be a lot trickier. But I don't want to say it's been easy, but where it's been much more fruitful and maybe easier has been recognizing where the extension, the technicals, and the market dynamics line up in such a way as to create these more major pivot highs and pivot lows. And then you combine that with the volatility that we've experienced, and you have a recipe to be making a lot of money this year as a smaller time frame trader. And because you need to then combine everything I just said with game planning for reward maximization. How many of us, and myself included, and I have no shorts on right now, how many of us basically shorted this exact high in the market? How many of us still have positions up from it on? If I could see hands, if I was speaking to a classroom right now, I bet a decent amount of hands just came up. We were all over shorting at the top. We were all shorting here. We all saw it. We all knew it. How many of you still have that short position on right now? All the hands go down. Not that many. I'll blame myself for that first and foremost. I probably should have done a better job saying, guys, we got to hold some of these positions. And, that comes back to me still working on improving for myself as a trader also. Like I said, I'm much better at holding these bigger moves to the long side. And there's no reason why I shouldn't be following the same rules to the short side as I am on the long side. Because on these up moves that we've had, thank you, Gabriel. I've been really good at holding for the entirety of these up moves and absolutely, to be real, just crushing these up moves that have come into the market. just by following the game plans I have for reward maximization, which is the exact same game plan that comes off of my training program class that pretty much everybody has access to, the game planning class. And it's the same thing on the short side. Like, if you are, and again, all the hands are going back up, anybody who's shorted at the top here, which we, like a lot of us did, if you followed my rules from the game planning class for reward maximization, you are still in the shorts. You're still in your shorts. Not as heavy as you are at highs, but you are still in those shorts. What Gabriel is saying here is true for me, and I'm kind of fine with that. And though maybe I should be working at continuously improving as a trader more. Like I tend, and maybe this is just the way that the market has kind of ingrained itself into me after trading a 12-year bull run that we've been in. Where what I'm doing is capturing the full move on the longs and only capturing the move on the shorts into the equilibrium zone. Like what Gabriel just said here, on the shorts, we're covering right at equilibrium. That's exactly what I've been doing. And that's probably just trained and ingrained in me from, dealing with the last 10 years of a bull market. Because if you were too greedy at almost any point over the course of the last 10 years on the short side, you end up just giving it all back. So a lot of my approach has been, really nailing these bottoms, which I've been able to do because of the team, not because of me, with impressive consistency this year. And then every time I'm, like I did the same thing. I shorted at the top of March also. I shorted the top here in August. And then I'm just like, oh, like the market had too big of a run. I just want to have this short on, as a trade, as a hedge, just for the expected pullback into our equilibrium zone. And then I'm going to be out of it really quick. And then I'm going to see what the market's going to do. And then I'm going to see if I can start building back into longs. Like that's kind of what I've been doing a lot of this year, which, obviously in 2020 hindsight has mean that I've left a lot of money on the table on really good short executions that I've had this year. But it's okay. I mean, it's not okay. It's okay, but it's not okay, right? Because you always want more. So I still have to keep working on certain things also. But yeah, it's just been a wild year, wild year. Anyway, what else, guys? Anybody else have anything? Isn't it also more expensive to hold a short book? Not necessarily. Depends on what you're short. Depends on the borrows goes. It depends on how fast the market goes down. Who cares how expensive it is to hold a short book if you're short these last 4 days with the rate and speed in which the market went down? It depends on the equities you're holding. I don't think that's a real deterrent to swinging short unless you're swinging short stuff that's really hard to borrow and you're having to repay that borrow every single day. Otherwise, it's just kind of some of those additional, overnight short fees that you get hit on a little bit. And exactly, Gabriel, markets tend to go down faster than they go up. Jackie, can you please go over your snap trade in the pre-market today and explain a bit of your reasoning for taking the position? Sure. So, first thing I would say about snap, and I was saying in real time, I just want to reiterate it. There's no doubt about the fact that I got a little bit lucky in this today. And let's not confuse skill with luck. There may have been some skill just in me getting involved in the trade, the execution of me getting long, things like that. But the fact that I'm buying a break of a seller that crossed the market down to $9, and then shortly after that news comes out that rips it to 12. I can't expect that. That was a bit of a luck aspect to it. This thing traded crazy today. Really crazy. So, I like to combine technicals and fundamentals to start with, so I got to mention that a little bit. You know, I describe myself as probably 85% technically focused and 15% fundamentally focused with what I do. I'm of the opinion on the more fundamental basis that a lot of the bad news on Snap should really be caked in at this point. Obviously, it's not good when two of your executives leave your company, go to Netflix, and you're letting go of 20% of your employees. But I don't actually view that as a bad thing with where the stock is currently. Like if it didn't have these bad earnings reports and these warnings that have happened for the stock, if it didn't have that, and the stock was trading up at $30-$40, and they came out with the news that actually came out on it, the stock would get destroyed on it because no one knows Snap's in trouble. No one's expecting that. Why are they laying off 20% of the company? What's going on with the earnings report that no one knows about? Like, they would destroy it off of that. Instead, you had that huge warning, and I think that honestly, I think that the executives of the company have made some amateur hour decisions on how they've supplied the market with information over the course of a couple earnings reports and that warning. But they came out with that really bad warning, and then they came out with a really bad earnings report. And I even felt at this time that this sell-off off of that earnings report, given the warning, was overdone. And that's when I was first kind of building into this long, and eventually with the market helping, was able to catch a nice bid here, and I liquidated the position, and it paid me. But given the warnings, given the bad earnings reports, at this point, I think restructuring is a good thing. Also, I have a decent understanding of the advertising business at this point, at least partially because my wife works in the industry, so I just get to learn about how the industry works. My understanding right now is that there's actually a lot of ad dollars out there that want to go towards advertising for younger people in general, and the companies that want to get the exposure to those younger people are really struggling to be able to do it through traditional means. Like the advertising TV complex, especially geared towards young people who are, let's say, 30 and between 15 and 30. It's pretty much non-existent. You're maybe through like an Adult Swim channel you're getting through to a few people, but even Adult Swim, which is cartoons, like later night adult cartoons, that's like people my age who are a little bit older who still watch that stuff because they kind of grew up with it. It's really not like those younger people currently. So I don't know. I just view at this point this company going through restructuring after all that bad news, in conjunction with my understanding that advertising dollars are seeking for ways to be able to get in front of younger people. And then, just for example, as you guys know, I taught martial arts for 30 years, and this summer, one of the reasons actually I'm in New York right now and not back in Idaho is the martial arts school that I've been going to my entire life. The person who owns it, he had heart surgery, so I've been managing the business for him out on Long Island on Friday evenings and Saturdays. So I'm out there, and everything for me, and I love to talk about this to you guys because you guys should do it the same way. Everything for me is market research at all times. So on Saturday, I'm talking to a kid who's a sophomore in college, goes to St. John's University here in New York, and I'm just like what are the people your age into? What are they looking at? Where are they spending their hours? Like as far as entertainment value and things like that. And he's talking to me about Facebook, Instagram, Snap, some other new one that I forget what it was called, Be Real or something like that, TikTok. And he was kind of just basically laying out to me what him and all of his friends do, and it's like for short-term content, it's TikTok and Instagram, like those Instagram reels. So those two things, TikTok being the big one. But for communication through friends, it's all Snap. He was like, yeah, we don't, like, my friends and I, we don't text. We don't use iMessage. We're all in Snap groups together, and that's how we communicate what we're doing and where we're going to meet up. And I'm like, oh, well, do you you know, when you're just texting your friends through Snap, are you getting advertised too? Like, do you see advertisements popping up? He's like, no, I don't see that, but you know, we'll all then be sharing like pictures back and forth through it also because you're already kind of in the app, and that's where I get advertised towards. So like, okay, like that's interesting to me. So, you know, Snap, obviously, the stock has just gotten totally destroyed. But I understand that there's a lot of advertising dollars that are trying to reach this group of people, like the kid that I was speaking to over the weekend. One way to be able to do that is through Snap. And with where the company is at this point, I don't think it's a bad for the stock at all if it went and go 20% of the company. That portion of the bad news, I think, is built into these earnings warnings and earnings reports. So if anything, at this point, like most tech companies, like probably all tech companies, when things were going so well and they had this crazy valuation, every tech company that was out there was overhiring like crazy. And now where are we seeing all the companies laying people off? It's all in the same companies that were overhiring when the valuations were insane. So you want to let go 20% of your employees at this point? You want to restructure? By the way, you're not going to be compensating them because they're not going to be working at the company anymore. They're not going to be getting those stock options that they can then sell into the market as the stock goes up also, which, you know, makes these stocks a little bit heavier too. I actually view this as a positive for the company. So that's kind of the fundamental thought process I had coming into Snap this morning. And then I'm watching the price action. My original game plan that I was looking to do, which I communicated in the morning meeting, was to buy back through the absolute low. So the absolute low of this entire down move is $9.34. This goes back to, from an execution perspective, not catching a falling knife. Like, sure, I'm telling you guys the thesis right now. Maybe my thesis is right. Maybe my thesis is wrong. Maybe my thesis is right, and the stock goes to $5, and then the market realizes what I know, and the thing works its way back up, which is the same as far as I'm concerned as being wrong. So this is where the execution really comes into play. So the first thing I'm thinking about is $9.34. And like I typically do, you know, if I'm really looking at something and I really want to have my eye on it and I want it to be a focus for me, I will start buying at least a little bit before then. So, you know, I had started buying some stock in this thing in the pre-market and was trading pretty heavily pre-market and trading after hours yesterday. I probably bought stock everywhere from like $9.16 to like $9.40, like smaller, you know, 100 shares, 100 shares, 100 shares, maybe 200 shares. You know, building a little bit of a position, understanding it's a cheaper stock, you know, so it's the worst thing that happens. It goes to zero on me, I guess. Um, but I want the execution signal to get heavier. The original execution signal I'm looking for the real trade to get heavier is back through 934. That way, again, I'm buying on the way up, not catching the falling knife. I'm not buying on the way down. And then what happened, I apologize, I probably should have done a better job communicating this in real time as I saw it happen. But, you know, I'm trying to get ready for the morning meeting and just doing so many things at once and trading. There were these large offers that were coming into the stock. I remember at one point pre-market, I got filled on a bid, I think, at $9.16, which was this low tick right here. And I was offered a little bit of stock at $9.26, just 10 cents above that. And I didn't get filled. You can see this high tick here is $9.26. I didn't get filled there. Even though that was the high, it was just a couple prints went off. Right in front of me at $9.25. And this, I had seen this offer come in actually several times. It was like 150,000 share sell order at $9.25 in the tape. Which, you know, that's a lot of volume pre-market on the offer there. Normally, you would never want to sit behind that, right? Like, there's an offer, a massive offer, $9.25. Why am I offered $9.26? Normally, you would never want to sit behind that. It was just that I couldn't sell any below $9.26 just because I bought $9.16. Like, I couldn't sell for less than 10 cents there. It just wasn't going to make any sense for me. So I was offered just behind him, and I actually didn't see that he was there right away until he was inside. I saw that, and it got filled. It got filled, which means, and that's when it upticked to $9.26. I was like, oh, I'm gonna get the fill easy, and I didn't get filled. I was like, how did I not get that fill? How did they just clear an offer out a penny in front of me that was over 100,000 shares, and then not fill my little 100-share offer like that was a penny above it? Like how, like that's almost like not possible. And I didn't get filled because right after a couple ticks on $9.26, a large order came right back into the market and crossed down to $9.24 and got filled. And I had seen that seller come in multiple times. I saw that seller come in after hours yesterday also. And then all of a sudden, I'm watching this thing, and you can see it here in this down tick, you know, the 830, 835 bar, basically this 830 bar, where you see the stock $9.23 high, $9 low, and that's like one of the bigger pre-market moves here. This same seller that I'm basically watching in the tape takes his offer and just crosses it all the way down to inside offer $9. Basically saying, I'm gonna hit every single bid between $9.24 where I currently am and $9. I need all that liquidity. I'm taking it all out. I don't care. I don't care what the pricing I get on it is. I want all of it. I need out. And then just sat there on the offer at $9. First showing size. The size prints over the course of that bar, maybe the next bar, and then the thing just starts refreshing on the offer behind it. That's like all signals, and this is tape reading stuff, which I don't go over this stuff as much anymore because it's not as important as it used to be. You guys should learn charts. Don't tape is only important in specific circumstances. This is probably one of those circumstances for the pre-market kind of news event, and I am good at reading tape. I just am good at it. I've got a lot of experience with it. It's how I used to trade. Now I'm primarily chart focused. So prints the entire size on the offer that's sized up to it's probably I don't know, it was well over 100,000 shares. Prints, and then it's refreshing on NASDAQ beyond that. And then that's how I know when I'm looking at it, I'm like, all right, this is a very real seller. Printed over 100K at $9.25, came back in, crossed $9.24, got 40K printed there, still was on the offer for some size, maybe got tipped a little bit, said screw it, crossed the entire market down to $9, showed size at $9, filled the entire size, refreshed beyond that. That's just that's an institutional seller executing out of this thing and who needs out because of whatever their interpretation is of the news that probably differed from mine. So when I see that in the tape, I'm like, all right, I wanted to wait for $9.36. Stock down ticks to a low of $8 and $8.92. So I really am waiting for this 934, but I'm just gonna take a bigger ad on the break at $9, and maybe that's gonna be the end of the seller. And that was it. $9 broke, took a bigger ad, stock began to uptick a little bit. I was actually pretty happy. I sold some stock at $9.16 from that I bought there, and I was pretty happy to get that sale. And I had more offered at $9.24, and I was like, oh, I'm getting really close to selling even more at $9.24. That'll be another great fill if I can get it. It looks like they cleared that seller. It's on the way up. It's looking good. And then the news hit, and I'm trying to do the morning meeting, and I'm just getting lit up on the offers that I had out in the market, and I'm trying to get more offers out because I didn't have offers. This is unlike me. I didn't have offers out at higher prices yet. At that point, I was kind of just waiting for the market to open. I didn't have offers above $10 in the stock, as an example. And then I'm just like, oh my god, this is crazy. And that's what I saw. So that's the answer to your question there. Can I see that on the SSE? What does SSE stand for? I'm looking at the level 2 in conjunction with the tape itself, is how I'm reading that. So the offers I'm talking about are offers that I'm of Street Smart Edge level 2. I don't. Street Smart is, what's that? Thinkorswim. I have no idea on that. Schwab. Yeah, I have no idea. I can tell you that for the softwares that T3 offers, Judy, which if you want to revisit that conversation, the softwares that T3 offers on the retail side or on the professional side have level 2 where you should be able to see that. That's where I was seeing but I'm not sure on more of the retail type platforms that are out there. But yeah, it's a combination of level 2 in conjunction with the tape. Cool. So I hope that helps. I kind of got to jump here, but so there was one other question from Trade 117, so I'll answer that, and then I gotta wrap things up because I'm supposed to be down on Stone Street meeting a couple people for a drink in about a half hour. From Trade 117, in terms of risk skew position sizing, how big would a difference between B and A be, and should C trades and below not be taken? Sure. So the way that I do this is dollar risk on the trade more so than tier size. So it's not like, an A plus trade is 10,000 shares and a B trade is 5,000 shares and a C trade is 1,000 shares or whatever. It's based on dollar amounts. And the way that I like to think about that is the dollar amount that you want to risk based on the grading of the trade versus what your max loss is. So I think that like a real solid A plus trade, which you should find very rarely in the market, is a trade that you probably want to consider risking an entire day's worth of risk on. So if your personal daily max loss, just to use simple numbers, is $500, then you want to risk probably your entire day on an A plus type trade if it comes along, because that should only happen once every month, once every couple of months, something like that, where everything lines up so perfectly that you've got such a incredible risk reward probability of success type of opportunity. And then you know what? Go for it. Risk your entire day. If it fails, well, you know exactly what you did. And then you can go for a swim for the rest of the day or do research or help the team out or whatever if it doesn't work out. Because again, we're in a game of probabilities and there's no such thing as 100%. And if it does work out, well, you better be making, if you risked $500 on that and it was a true A plus trade and it really works out perfectly, you better be making at least $5,000 off of it. And then you want to build down off of that, right? So going off those numbers, if that A plus trade is like the full 500, I probably would have a BB half of the day basically, or even less than that. 200, 250, and then a C would be like the lowest end of it, and that would be like $100. Anything worse than a C you wouldn't take. Is kind of generally how I look at it, but I'm purposely speaking broadly because I think that every person is unique, every trader is unique, every approach is unique here a little bit, and account size is unique. So I'm like purposely speaking a little bit broadly and trying to just give you a rough idea, because I think that you should dive in somewhere along those guidelines and try to come up with a system that actually makes sense for you. Negative video here after hours. Maybe trading down a little bit on it. Cool. Good stuff. All right, gang, I'm going to wrap it up. Good afternoon meeting today. Overall, again, a good day. Slightly disappointing day. Had a lot of potential, but still, good stuff, good call outs. Have a great night, everybody. See you all tomorrow.